All right, let's get right into it here. Hope you guys had a good day trading today. Market tumbled down after the Powell's speech, and obviously that's something we've witnessed last couple years. Every single time if Powell comes on TV or whatever and starts speaking, we see market coming down. It doesn't matter what he says, so don't really pay attention to. I wouldn't really pay attention to that unless you really want to focus on trying to dissect everything he says and try to figure out what the market is going to do in the micro term, right? Unless you want to do that, you want to micromanage everything, you want to really get down to what this market is going to do on a day-to-day basis, then by all means, dissect everything he says and see how the market behaves. But for those of you who want to really look at things in a really objective manner and not wanting to let this market to turn you around, bully you around, and constantly trap you and fake you out and make your life miserable, right? That's not what we want. We don't want to become victims of this market's, bullying us around. I mean, just look at this. You're going all the way back to 2009, right? So we're going all the way back to, this is 2008 peak right here. Financial crisis. We saw 55% crash. Right, there was a real recession that we gone through back in 2008-9, and obviously we witnessed the market bottom in 2009 there. Ever since then, our market has done incredible things. If you look at this, Spider was trading at close to 80 or 90 or something like that. 2009. I mean, we almost hit 490 or so, almost 500 during 2020 on peak. We saw very steep decline though during last year, 2022. There was 27% correction on the S&P here, and then obviously we seemingly saw that major low during October of last year, and then we made a nice swift run to about 450s or so, and we're seeing that pullback today. And obviously this is the same question you're going to get on every single turnaround and correction, right? And so you just really got to ask yourself, I mean, how many times am I going to allow this market to shake me out, right? And I'm talking to all the long-term investors, okay? If you're day trading, short-term trading, it doesn't apply to you, okay? I've done a lot of the 65-minute chart analysis. Well, today we're looking at long-term. Today we're looking at primary term. Today we want to understand the big picture. I'm talking to the long-term investors. We're talking to people who trade things much more longer term, which in my opinion, that's the best way to truly build wealth. And anything else, you're just constantly hustling in the streets and really nothing to show for after many years. And I truly believe that that's the case for any sort of a micromanaging trades. But anyway, so looking at this, how many times, I mean, if you've been trading this market for many years, how many times has this market faked you out? How many times? I mean, just looking at 2022 lows. I mean, just 2022 lows. You know, the characteristics of these two guys, right? We're talking 2022 and 2020. COVID lows and 2022 lows. Their characteristics completely different, because during COVID, what we saw is the fastest decline ever recorded in history of stock market. That's 2020 decline. We've never seen stock market come down 35% from the peak in like about a month. That has never happened. But we also never seen after a move like that, market just V-shaping higher and making new all-time highs in just less than 4 months or around 4. That has never happened either. So we've witnessed something we never ever seen ever in the entire history of stock market. That's 2020. So you should be grateful that you actually became part of the history, that something, I mean, this is going to be in Guinness Book of Stock Market. That has never happened, what we witnessed in 2020. But what's really important is so many of you, so many market participants, we're talking almost every one of them, majority of retail market participants missed out 2020 lows And then they started coming back into the market, what, late 2021, when market seemingly kept going higher every single day since 2020 April. So for like a year and a half, market just wouldn't stop, right? Remember this? But that happened after it got you out. It got you completely scared of this market. The Great Depression 2.0. And when I talk about these things, people always like to say, well, okay, this time's different. This time it ain't nothing like 2020. You know what's funny about all this? When I was talking about something similar during 2020 lows, go check my work during 2020 lows, people are saying the exact same thing. This time is different, okay? What are you comparing to now? What? No, this animal is gonna be different. We're going to great. This is it. We must prepare for depression that is gonna be greater than 2008 and 1929. Remember, that's what people were saying during 2020. How many of you tired of this market constantly fooling you like that? And of course, market does straight up V-shape higher, seemingly never ends. And then people didn't buy here. Obviously, people started buying it near the peak. And then that's what 2022 was. You know what 2022 was for? For some of you who chase long, and all of a sudden now you want to become a long-term investor after this thing went from 180 to, I don't know, like 400 something. Well, that's 2022 for you, to make sure market can punish the latecomers. That's what 2022 was all about, right? And I'm talking in a primary long-term sense. The market does this punishment thing in the long-term sense and then in the mid-term sense, right? So now what we're dealing with here since the July peak, that will be more like a mid-term correction, right? And this would be more of like a long-term correction. Within the long-term primary uptrend, that will be the correction within that primary term uptrend, right? Keep in mind, I've been trading this market for over a decade now, and that I've gone through all these declines, and I'm here to tell you that whatever you're hearing now, whatever narrative, whatever is people are talking about, whatever is the people are saying, whatever the thing that is making you fearful, whatever it is, interest rates, yield curve, whatever it might be, that's what people are talking about on every corrections that came before it. It's just little different variations of narrative, but it's still same thing people talk about. And every time when I say this, people are like, well, this time it's basically saying this time is different, right? And then obviously, same people who said this. And the thing about all of this, right? Think about all this this video is gonna more be like a talk than analysis. But I'm gonna get into my analysis part. But let me get this out. Think about all of this is that once you're fixated, think about this. This is really important. Once you're fixated, and you guys remember 2015 and 16, okay? Once a lot of people thought that was it, right? The market is gonna we're supposed to, market was up too much. We're on a Titanic. That was sort of the terminology that people are throwing around, right? Back in 2015, like global financial market meltdown. That's what they're saying. 2015, 16, global financial market meltdown. That was it, right? If you're fixated in the fact that this market is either rigged or is up too much, and you're fixated in this idea, right? Think about this. And that was when Spider was trading about 180, right? That's 2016, 180. So during Spider 180, you're fixated in the fact that this market there's no way that I can go long here, right? Well, my friend, you just missed out from 180 to 500. You just missed out this move. Think about this though. You thought you're fixated in this idea, whatever the fundamental things that you've heard on YouTube or whatever who you talk to, any blogs you follow, these doom and gloomers you've been following, right? You're fixated on this idea. Then there's no way, right? Spider 180, market is up too much. What are you gonna say when Spider's at 450 and 500. You already missed out this much. You're waiting for a 50% correction to the downside while missing out like 160% gain to the upside. Does that even make sense? That people are waiting for 50%. I mean, if I go, don't even let me go to NASDAQ or semiconductor, because then you're missing out hundreds. We're talking 300-400% move to the upside while you're waiting for 50-55% corrections for seemingly 10 years now. And I say this because this is the psychology of a human behavior when it comes to stock market. And that's why you might feel like, if you're feeling like you're constantly, trading, and you're constantly like, you know what I'm saying? You're constantly feel like you're just all you're doing, right? Feel like all you're doing is just chasing after, just to make up for the losses. Like, even though Spider went from 180 during 2016 lows to 400, even though Spider is up, right? If you track your trades, I bet a lot of people don't even track it, then you realize you're constantly just getting faked out, constantly getting trapped. You're constantly just, because you think you're doing, because you don't want to, you're fearful of some sort of a great cosmic colossal damage in the stock market, that you're still waiting, and then market doesn't come. And what happens is then on the next leg run higher, people miss out, market makes sure to get you out, get most people out, and then it goes where it needs to go. And that's been the story. And that's why you have to understand the secular bull market versus secular bear market, because within the secular bull market, you will witness some crazy, disruptive, disgusting, horrendous declines. But if you know the secular trend, what if you bought here? What if you bought here? What if you bought every major lows and you rode it all the way up? Would that be the way to truly build wealth? Or you're going to be out there hustling every day, day trading here, short-term trading here, nibbling here and there, trying to make some rent money here and there. But after many, many years, why do you always feel like you're constantly chasing after, right? Just to break even, just so you can, just constantly chasing, just so you can get your money back that you've lost, I don't know, many years ago or many months ago, or you're just constantly trading and trading, but you don't see any sort of, advancement in your trading career. Is because you're focused, you're micromanaging? Is because you're following the fantasies and there are too many people out there, making you feel like that these day trading, short-term trading thing actually work. And there's people out there, you're always chasing after these people who YOLO'd on Bitcoin or YOLO'd on Tesla, and then they made tons of money. There are people who win lotteries. There are people who win lotteries, ladies and gentlemen. So if that's what you want to win a lottery, then there's nothing else I can tell you that is gonna. You might wait rest of your life, and you might not able to ever achieve any sort of success, because winning a lottery is nothing to do with your skills. It's just some people just getting a blind luck. And a lot of times the lottery winners, what happens to them? You know what happens to them, right? So what's important about this? Here, let's go. Let's actually get into my analysis. My intro is 15 minutes. Okay, that's what's very important. So you see this long-term moving average right here. That pink, thick pink, that's my primary to moving average. And what happens is, as the trend, what happens is it could potentially get underneath these primary to moving average. It's done that before. Since 2009, we did it in 2012, we did it in 2015-16, we did it in 2019, we did it in 2020, of course, we did it in 2022. So there's been 1, 2, 3, 4, 5 incidents where we got below this primary term moving average, which is on my daily chart, that thick pink moving average you see, right? What's important though is after a steep decline, what happens after that? It gets below the primary term moving average and the price gets back above it, and then it holds above it, right? What I like to call a retest, which happened, which it could happen, right? Like you see right here, you look at 2009, it retests and gets rejected and tanks. We reclaim here, 2010, and then retest right here. And then it makes higher low. We got below it. There's a retest. There's a retest, right? You see the theme here, right? We break below it, but there's retest. And you have to understand, you can't be too precise with these kind of moving averages. It could go lower a little bit. It's just the vicinity that what you want to worry about. Also the trajectory of that moving average, right? That's 2015 and 16. There's a retest there. There's a retest there. Market continues to move higher. Yes. Here's 2019, right? We broke below it very, very fast. And then what happens? It broken above the primary term moving average there, but retest, retest. Yes. 2020, COVID lows. There's that retest, right? There's retest, but it didn't quite get there. It just was in that vicinity. So we just looked at last 13-year worth of data. Every time when we do see that moving average, gets reclaimed. So here, we're looking at current price. When do we reclaim that primary to moving average? Right here in this vicinity, right there. You see that how that primary to moving average right here, it acts as resistance. You see it went up and tanked here. And that was not your situation, because that was pretty similar to what happened in 2008 and 9. So if the market was going to completely be dismantled and get into a just brutal recessionary bear market like 2008 and 9, it would have completely tanked here. It wouldn't even actually retest second time, but it did. But we would have continued with the lower highs and lower lows. That would have been it. And even if this thing would have gone up there, it would have came back down, made new lows. That's what it would have happened. That's March of this year. But something happened. Something that it didn't happen in 2009. It happened during this year, March. What happened? We got up to the primary to moving average, which is a prior resistance. Remember, it was prior support. Remember that that primary to moving average is very, very important. As I've demonstrated earlier, as you can see right here, we initially fall back, but we broken above it. We broken above it. Not only that, in that process, market faithfully made higher lows. This is something I've been talking about this entire year, right? Since my last October low, bullish divergence, reversal, bottoming signal video, I've been talking about these subtle higher lows and higher highs. Yes, what's higher lows and higher highs? That's when the market is ready to possibly establish an uptrend, right? It's going to start with the higher lows and higher highs. And once it broke above it right here, that was very crucial. And what happened was that pivotal swing high right here. It is no longer lower highs and lower lows. What's the definition of downtrend? Lower highs and lower lows. If you go to your real recessions, you will continue to see these lower highs and lower low, lower high peaks and lower low lows, right? But something changed on this right here. That's higher low or higher high for the first time. So now look at this in the midterm sense, mid to long term. Market made low, October low, and then March low. And now market needs to create that another higher low. And then we don't, again, the problem with that higher low is no one knows how steep that high, how shallow or how steep that high or low is gonna be. It could be as shallow as this. It could have been as shallow as boom, 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 boom. Yes. Or it could have been as deep as coming all the way down to 410, retesting the low primary term and then that. Or it could just come down here to long term. You see that long term moving average? That's my long term right here. That thick blue line, grayish blue. This is where we found support just last week, last lows right here, which coincided with my 50% retracement. Or it could come down to retest the mid-term or the long term. Again, that's the long term, that's primary term. And then get up. So we don't know. This is where, because of this unknown of that next possible higher low, this is where everybody starts to freak out. This is why. Of course, nobody knows. Of course, it's unknown. If everybody knows, everybody will be rich, right? Nobody knows. Nobody can ever figure out what that low is going to be. No one. However, we can kind of gauge, not in a precise price point, but sort of the vicinity, right? So we're sort of in the vicinity of in between the long-term moving average and my primary term moving average and this vicinity right here. That's 419, 410. So I think as long as we're, again, don't be, you'll be like, oh my God, okay, it just got like 410, like 409.50. I think your analysis abolished now. That's not why there are numbers there. These are numbers, just so you know, you gotta be aware of this. Again, right now, spider's at 432, right? 432.30. So we don't know. We don't know exactly if this is going to be here at 432 to do this. It's going to come down a little more to 420 to do that. Or it's going to come all the way to 410, 408 to do that. We don't know. That's the problem. This is what creating a problem with a lot of people, because they do not understand. And this is how so many people miss out opportunities, because sometimes market pulls back just a little bit and then shoot back up. Sometimes market pulls back like a little more than normal, and then it goes back up. Sometimes market really drills down and then really drills and dig deeper. And then finally, everybody's like, oh, because here, it's very important. This is why is this happening in the short to midterm sense. You know what happened, right? I'm going to tell you what happened. What happened was, you think a lot of people bought the dips here during 2020 lows and 2023 lows? No, nobody did. Most people didn't. So what happened was most people like, you know what? If it clears 430, right? That very prominent and very conspicuous level, right? That 430 that everybody can see. If it clears 430, I'm going to go bullish. I'm going to go long. And so what does the people do? What do you think people did? They're like, yeah, okay, we cleared it. And then people start calling that, oh, it's going to go to the moon. They're going long here. What do you think those people who got long after it cleared 430? So people are going long after like 440, 450. What do you think these people are doing? In panic. That's what this is what's happening right now. This is happening because people chase long instead of buying it, these lows. But they chase long, and then they're panic selling. That's what's happening. And then they're micromanaging everything. They're in a total fear. They're holding on to everything that they can get their hands on. So of course, market had to break below that. Market had to break below this pivot. And that's right here. That's right there. So remember what I said. I'm going to end the video with this. The trajectory of the moving averages are more important. Also, that's the death cross right here. That's the golden cross right here. Right? You see that they're crossing. See how they're crossing down? You see how this is crossing up. That's a golden cross. And remember what I said earlier. The trajectory of the moving average is more important. right? Versus, you know what I mean, the precise level where the moving averages are. So here's a fun fact. After market has corrected 25% or more, not stocks, like we're talking index, okay? So after the S&P 500 index have corrected 25% or more, and then market reverses back up and gets above my primary term and my long-term moving averages, there has never been an incident where market came down and then just crashed down and got into full-blown bear market. That has never happened, statistically speaking, right? So historical probabilities, the statistical probability suggest we have a higher probability, right? Because nobody knows for sure. Higher probability. And some people really love to bet on that very slim odds. And if that's you, you know, that's your prerogative. But me, I would like to bet on the likely scenario, likely outcome. And also you got to put in that psychological aspect of it too, so that you know why this is happening. Not because whatever the thing that you hear on news, okay? So now, market has successfully got people out, punished those chasers who chase long here. Now this is a level. You should really look at this instead of being fearful and you know, this is going to turn into you know, full-blown bear market, because you've done that last 10 years and you missed out every opportunities. So now is the time to look for opportunities. If there's any kind of good quality stocks that are beaten down heavily that potentially you could possibly go long, or maybe this is time to maybe go long on some of the you know what I'm saying, index funds that you're looking at and stuff like that, or maybe some leveraging, whatever it is, because you want to start looking for opportunities when things are cheap, not when things are looking to be breaking out. This is a problem that most people have, is they want to buy when things are breaking out. No, you want to buy when there's blood running in the streets. That's when everybody else, they're all panicking. Bears are, you know, pumping their chest, and bears are, you know, seemingly just think like they're unstoppable, invisible bats. When all the bulls are shaking in their boots, all the bulls are just shaking their boot, they're just extremely fierce. That's when you have to go against the crowd and start looking for opportunity. If you can do that, I think, and especially if you're one of your long-term investor, then I think you succeed in this market. And I recently wrote that article, Spider to 500. Perfect. I'm going to check that out, and I think that article, that analysis, will be still valid as long as you know, we stay above in some of these this moving averages that I mentioned, the long-term and the primary.